The stock market is currently closed, as today is Sunday, June 7th, 2026. Looking back at the final regular trading session on Friday, June 5th, 2026, Nokia stock, trading under the ticker symbol NOK on the New York Stock Exchange, finished the day at exactly $14.38 per share. This closing price reflects a sharp intraday drop of 11.5%, with the equity shedding $1.87 throughout a highly volatile trading session. While many investors on standard retail brokerage apps woke up expecting a quiet end to the week for this European telecommunications giant, what actually materialized on the tape was an intense institutional liquidation that completely caught the broader market off guard. The immediate catalyst behind this double-digit plunge was not a standard earnings miss or a visible product failure, but rather a sudden intersection of massive debt restructuring and shifting retail sentiment that triggered heavy automated selling. Nokia corporate headquarters issued €500 million in new senior unsecured notes maturing in 2032, with a fixed annual coupon of 3.625%, aiming to refinance its outstanding debts due in 2028. Institutional desks immediately parsed the terms of this Euro medium-term note program and began shifting capital, while short-term retail traders who had recently pumped the stock on social media platforms simultaneously ran for the exits. This sudden convergence of a corporate debt swap and a retail momentum flush caused the trading volume to explode to over 185 million shares, a massive surge compared to its usual daily average, pushing the equity straight down to test its crucial support floor. When you look at Nokia stock today, the common expectation among average market participants is that it operates as a slow, stable, almost boring legacy technology play, with a solid balance sheet that simply ticks along with global infrastructure buildouts. Many individuals utilizing self-investing strategies or looking for baseline investment help through traditional investing sites view it as a safe defensive asset because of its massive cash reserves and extensive patent library. However, the reality of the situation is far more complex and highly volatile, as the stock has transformed into a high-stakes momentum playground, driven more by speculative capital flows and sudden institutional rotations than by slow-moving corporate metrics. This exact tension between what retail investors believe they own and how the actual equity behaves on the institutional tape is creating massive traps for long-term holders, while opening up fast-paced tactical setups for short-term active market participants. This relative weakness is not a single isolated event, as recent trading history shows a persistent pattern where big institutional money has been actively rotating away from Nokia whenever European equities experience broad market pressures. Throughout May and early June, the asset repeatedly led the downside during weak international trading sessions, falling over 4% on multiple separate occasions, even when the broader European indices managed to close flat or slightly green. This continuous distribution by institutional desks indicates that large-scale asset managers are growing highly sensitive to Nokia's rich valuation relative to its immediate growth constraints, preferring to park capital in high-flying alternatives like Nvidia stock or Apple stock instead. When speculative buzz on consumer chat forums occasionally drives a 10% spike in Nokia, the follow-through almost immediately collapses because the long-term underlying bid from major wealth funds simply isn't there to sustain the upward momentum. If you are tracking international equities using a traditional individual brokerage or managing your own long-term wealth through advanced automated platforms like Schwab Intelligent Portfolios, you have to recognize that Nokia is currently caught in a fierce macroeconomic tug-of-war. On one hand, retail traders look at the nominal single-digit or low double-digit share price and assume it is a cheap entry point into global infrastructure, frequently buying fractional shares on modern applications to build out speculative positions. On the other hand, professional traders executing large-scale strategies across professional corporate networks see a premium valuation where the market is paying an inflated multiple for each dollar of actual corporate earnings. This fundamental mismatch means that any time the broader macroeconomic landscape experiences a minor shift or interest rate anxieties reappear, this specific equity overshoots aggressively to the downside as momentum buyers bail out all at once. To fully understand why this structural disconnect exists, we have to look closely at what Nokia actually does today and break down the specific components of its modern business model. Far removed from its historical identity as a consumer mobile phone manufacturer, the company operates as a major global supplier of high-end telecommunications equipment, focusing heavily on mobile networks, fixed access lines, and cloud network services. Their primary business revolves around selling physical hardware, advanced routing software, and long-term service contracts to massive telecom providers, national governments, and large mission-critical enterprises that need to build out nationwide data infrastructure. They generate substantial high-margin revenue by licensing their massive global portfolio of cellular and connectivity patents to other hardware manufacturers, which serves as a critical financial cushion when their primary hardware sales experience cyclical slowdowns. Despite having an incredibly solid balance sheet with billions in core common equity, the central issue limiting Nokia's long-term upward trajectory is its modest return on equity, which historically hovers under 6%. This low capital efficiency means that even though the enterprise generates substantial top-line revenue, it requires massive continuous capital expenditures to design, manufacture, and deploy physical networking infrastructure across the globe. This capital-intensive reality stands in stark contrast to asset-light technology giants like Apple stock or the pure semiconductor design models seen with NVIDIA stock, both of which command much higher valuation multiples because they extract far more profit from every dollar of capital invested. Consequently, long-term institutional investors assessing international assets often choose to allocate capital towards cleaner growth profiles, leaving Nokia exposed to sudden swings driven by short-term sentiment rather than steady long-term accumulation. For anyone navigating online investing or managing an active individual brokerage account on platforms like SoFi Invest or a flexible interactive brokers platform, identifying these institutional patterns is absolutely vital for managing downside risk. When you look at how different trading platforms process these sudden volume spikes, it becomes very clear that retail-heavy venues experience massive liquidations when key psychological support levels fail. For instance, when the price action cleanly broke below its $16 handle early in the week, automated stop-loss orders across retail investing sites triggered sequentially, accelerating the downward momentum and turning a minor structural pullback into an 11% rout. Active traders who utilize advanced option strategies or execute precision positioning on an interactive broker's account look at these sharp drops not as random market noise, but as clear indicators of where large institutional blocks are rebalancing their portfolios. Please comment below how many shares of Nokia stock you currently hold in your portfolio, and whether you are buying this double-digit dip or waiting for lower levels. Looking out into the upcoming calendar year, the forward-looking outlook for this telecommunications giant will depend entirely on whether its reality can finally start to outpace the conservative expectations currently priced into the market. A key upcoming operational catalyst to watch is the Wavelength APEC exhibition in Bangkok, where Nokia is scheduled to showcase its next-generation network interface devices, quantum-safe data encryption solutions, and high-capacity modular optical platforms. If these advanced, security-focused enterprise products find rapid adoption among major corporate data center operators and sovereign cloud providers, it could open up a lucrative, high-margin revenue stream that diversifies the company away from its highly cyclical telecom carrier business. Additionally, the upcoming S-Rexperts event series in Europe and the Americas will serve as a crucial gauge for how effectively the company is capturing new enterprise clients who are looking to upgrade their internal routing and automated switching capabilities to handle massive artificial intelligence workloads. However, the primary operational risk that continues to threaten the bull case is the intense global competition within the mobile infrastructure market, where tight corporate spending among major telecom carriers is forcing equipment providers to protect market share through aggressive pricing. If major global carriers continue to delay their next-generation network upgrades due to persistent macroeconomic pressures or elevated corporate borrowing costs, Nokia's high-volume hardware divisions will likely face prolonged revenue stagnation. Furthermore, if the broader market shifts further into a defensive risk-off posture, institutional money will likely continue to rotate out of sensitive international assets and consolidate into dominant domestic equities that possess massive pricing power and immediate capital efficiency. Therefore, anyone managing their own capital through traditional online investment channels or utilizing specialized Fidelity investments must maintain strict risk boundaries around this asset, as its current price action remains heavily bound to global sentiment shifts and large-scale currency flows. In summary, the central story defining Nokia stock right now is a stark contrast between a stable corporate foundation and a highly unstable, flow-driven trading reality that continues to catch retail portfolios completely off guard. While the market expectation frames this company as a conservative, long-term infrastructure play with deep value, the operational reality shows an equity caught in heavy institutional rotations, facing distinct margin pressures within its core physical business. The recent 11.5% plunge down to $14.38 serves as a vivid reminder that solid balance sheets do not automatically protect an international stock from intense sentiment liquidations when short-term retail buzz fades away. Moving forward, the true test for the company will be its ability to successfully convert its upcoming product exhibitions into tangible, high-margin corporate contracts that can fundamentally reset its low return on equity and force institutional desks to permanently revalue the stock. Until that structural shift materializes on the official financial filings, the asset will likely continue to trade as a highly volatile tactical vehicle, where strict technical discipline and an accurate understanding of institutional flow matter infinitely more than old-school market narratives. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. BS bags S. Don't forget to like, comment, and share this video to support the channel. Hearts S.